Tax arbitrage is you spend $1 and you get more than $1 back. Okay, so you spend $1, you get more than $1 back. I bought artwork for 300 grand that I've got $670,000 back from the government because of something called book value versus appraised value and donations. You know, I've done conservation easements where I've forfeited the right to develop property and I've gotten more tax advantage than the cost of the property. We have clients that have used historic easements where they bought buildings, preserve the facade of the building, get a massive tax deduction worth what they bought the building for, but they can still rent it out. That's tax arbitrage.
Garrett, let's dig into some cash recovery ideas, and then we're going to open it up for some Q&A. So get your questions ready for Garrett.
Okay, this is going to be fast because I want to give plenty of strategy, and you could always play this back in slow. So, you know, look, 83% of people have an error on their credit report during their lifetime. As a business owner, 25% of people with an error on their credit report get denied a loan they would have otherwise had. So a good credit score can save you on insurance costs, car insurance, homeowners insurance, as well as interest rates, which right now they are so astronomically low. I urge you to refinance if you haven't refinanced something in a while. And I urge you to get access to capital. I normally wouldn't say borrow money, but it's so cheap right now, and businesses are going to be on sale in such a substantial way. And there's going to be a massive transfer of wealth over the next 3 years, the largest the world has ever seen. But people with cash will be able to capitalize on that distressed opportunity and bail people out and make money on the buy. Keep that in mind. How do you make money on the buy? How do you focus on cash flow with your investments from day one? And if you can achieve economic independence, which have enough cash flow from your assets to cover your basic expenses, you could swing for the fences in your business knowing that your foundation is solid and handled, which means you don't have to diversify. Diversification is a tool when you have so much money you don't know what to do with it as preservation. It is a prevention of wealth creation if you're diversifying on the way up. Focus, not diversification, is what creates wealth. Andrew Carnegie said he put all of his eggs in one basket and watch it like a hawk. That's the key. But if you build your protective expenses, you have permission to be focused. If you're economically independent, you have permission to be focused because you're not going to put your family in harm's way. So
Garrett, what you're saying is people get, you know, this multiple income stream way early in their wealth creation process, and that actually stops them from being able to capitalize on the potential. Like everybody in SaaS knows that every dollar of MRR at different stages of growth has like it's built in multiples. Like somebody's going to pay you for that in the future. And when you take your eye off the ball on that growth, you're giving up that potential multiple into the future by trying to be diversified, right?
Yes. So take zero money out of your business and instead let me do this specific thing for you. Let me help you pay less in tax. You have the biggest partner in your life called the government. And if you learn how to legally and ethically navigate this, it's going to massively impact you. So look, I'm just going to give the tax framework real quick, Dan. It's going to take me 3 minutes, but this will be really helpful. 3 buckets. I want you to draw 2 vertical lines so that we have 3 buckets in this tax framework. The first bucket is going to be the team. Okay, the team is the first bucket. Seems simple, but it's the hardest to implement. The second bucket is going to be deductions. And the third bucket is the game changer called reclassification or reclassify. So there's 3 people on your team that are required. Number 1 is a bookkeeper, controller, or CFO, just depending on the size of your business. Timely data means you pay less in tax. If you don't have timely data, you're going to overpay and you're going to have unnecessary stress. Second person on the team is a tax strategist. This cannot be a historian. This cannot be someone that goes, you had a great year, here's what you owe. This is someone you have to meet with every 3 months to discuss the tax strategy of how you're going to maximize deductions and understand how to navigate. The third one is an attorney. The attorney that you're going to bring into your life, that attorney can be a tax attorney if you've broken the 7-figure mark of revenue. If you're just under it, it could be just a corporate attorney just to choose the right, corporate structure initially. But the tax attorney is going to be responsible for probably 2/3 of your tax advantages. And the second piece of this is when you meet with them every 3 months, I want you to have all 3 of them on the call, but think like an entrepreneur, not like someone who doesn't understand finance. Their job is to help you navigate this in a way that doesn't get you into trouble. Your job is to brainstorm it in a way that they can interpret and figure out how to help you. So when I get on the call, I go, Dan, I went to Italy for a few months, and I just said, hey, I'm going to Italy. I want to write this trip off. And my accountant chuckled, and I go, no, I'm serious. I'm like, here's what I'm going to do. 1 day mastermind over the 2 months. There's 1 day where they can come to the villa. Number two, I have a list of all the guests so far. 3/4 of them are clients. The only ones that weren't were family members, because I don't try to create the brain damage of helping family. Because then they want to talk at all hours about it, and they want it for free, and they want to take on twice the money. So anyway, 3/4 of the people that are coming to stay are clients. Third, I want to go to where my family's from, and I want to film it to be put in an origin story. By the end of the call, 55% of the trip was a write-off. The one thing that I got that everyone can get from that trip is you have to have an annual corporate compliance meeting. I think better in Italy with wine than I do in Utah without it. So I like to write part of the trip off for my annual corporate compliance. Everyone should be doing that, right? So that's what this quarterly call's like. You're just brainstorming with them. I got a Can-Am since I saw you last, Dan. I got a Can-Am at the cabin. It's ready for you. X3 1000 turbo.
I'm coming, bro. I'm coming.
You're gonna tear it up.
The borders.
I can write off 50% of it because it's on the intro to my podcast, and because you'll sign a release form with my company to be able to drive it. So 50% that's a write-off, because once again, I started the call, we're like, yeah, like you're gonna be able to write that off. I'm like, well, look, it's in the video. I'm using it to entertain clients. So 50% is a write-off. Okay, so quarterly, you're gonna meet with them. Now, every 3 years, you wanna look back and see if you've missed anything. You're in software. Anyone in the US that hasn't done R&D credits, you've way overpaid tax. Anyone in the US that doesn't know about 199A, you've way overpaid in tax. Like, this is so much money back into your life, right? So those are just two things that you can go back if you missed and get a refund. And if you're in the US, again, there's something called net operating loss, where you can go all the way back to 2015. If you had years where they capped out your losses at 80% of your income, that cap is taken off, and you can take high income years against high expense years, match them up, and get a refund. I could talk about this shit for way too long, but I just want to at least plant the seeds here.
Let's go deduction, reclassify, and then we're going to open up for Q&A.
Yeah.
I want to get
deduction,
real.
Simple. Two things. Number one, every time you spend money, ask, can this apply to my business? And if it does, number two, you document it. I don't care how you document it, you just document it, so that then you can have this conversation on a quarterly basis to find out if you can actually write it off. By the way, if everyone hasn't taken advantage of the Augusta rule in the US, you're missing out, because if you have to be at home and you're doing things like right now, if Dan were doing this from the US, he could write this off for the use of his home, and then he gets that tax deduction, but doesn't have to claim it as personal income. So for me, it's just like 20 grand in my pocket every year, just knowing that one strategy. That's a deduction strategy. There's tons of them. Go to wealthfactory.com/tax, and there's a bunch of freebies there. So reclassification is a game changer. There's 4 pieces of reclassification. This is where the attorney is essential. Number one, how do you take your active income and make it more passive? That's the first thing. There's a few ways to do that. How you pay yourself in a corporation would be one, or if you own assets and you can take more income through the asset than through a W-2 income. Number two, can you take ordinary income and make it capital gains? In the US, ordinary income is 37.5%. Capital gains can be 0, 15, or 20%. So I do that through something called an 831B captive insurance agency, where it all goes in pre-tax. And when I take it out after a year or later, it's capital gain. For anyone that's doing business internationally but lives in the United States, for example, let's say you got a bunch of Canadian clients, you can set up an international sales corporation, an ICDISC, and that will all be capital gains on your international sales, which is super cool. The third thing is tax-free income. If you've never heard of a Section 1202, well, it lets you sell a business for up to $10 million tax-free if you qualify as a C Corp. Or if you're not familiar with the charitable remainder trust, it allows you to donate your business, get a tax deduction, then sell that business tax-free, and you're the first beneficiary of the trust. You just have to leave 10% behind to the charity when you die. And by the way, for the Canadians out there, let me just tell you this. Like, I gave this to Yuri when I was at a talk here, who's a Canadian out of Toronto, and he just took it to his accountant with the framework. He said it was a 6-figure savings per year. So I'm giving the framework. I just happen to give US-based examples, but the framework works in every country. I just don't know what the tax-free structure is in Canada. There's a 1202 in the US. In Canada, who knows? But I think it says Hoser or A in it. I know it's something like that, or process. It's something
or
about
a boot.
Yeah, a boot, the process. So, and then the fourth thing is tax arbitrage. And here's what I want everyone to commit to moving forward. You're never going to spend $1 to save 37 cents on something you wouldn't have bought otherwise. Tax arbitrage is you spend $1 and you get more than $1 back. Okay, so you spend $1, you get more than $1 back. I bought artwork. for 300 grand that I've got $670,000 back from the government because of something called book value versus appraised value and donations. I've done conservation easements where I've forfeited the right to develop property and I've gotten more tax advantage than the cost of the property. We have clients that have used historic easements where they bought buildings, preserve the facade of the building, get a massive tax deduction worth what they bought the building for, but they can still rent it out. That's tax arbitrage. So hopefully your brain's exploded by now as I just bombarded you with a ton of information. But the good news is we have a Q&A, and I also have a guide that shows all the answers to the rest of this, unless you want me to do a 5-minute answer everything that's in the worksheet. Dan,
no, what we're going to do, first off, let's give Garrett some love. Let's see the fingers. All right, you found the equivalent of me and SAS in financial wealth. I mean, Garrett.
That's why we get along, Dan. 100%. That's why we love each other, yeah.
Yeah. All right, so let's open it up. If you have a question for Garrett, just put your hand up in the participants tab. Just put your hand up. We'll bring you up live. You can ask your question around some of these tax codes. But Garrett, before we get into it, let's talk about diversification. Just like 2 minutes on because we talked about real estate in the past and you're like, yeah, it's bullshit. I used to own apartment buildings. I think it's a very fresh perspective. Let's talk about it.
So the first thing everyone has to understand is that we all have our own investor DNA. Like, you're going to know software in a way that a lot of people don't, which gives you a strategic advantage. So you look at your core values, because values are like a script of what you're going to pay attention to and what matters. Then you look at your drivers, which is where you have this extra energy towards something, or you'd be reading about it anyway. Then you take your competencies. Where do you have an ability that other people don't have? And then you focus there instead of diversify. Diversification is for people who don't take responsibility for their finances, or they have more money than they can actually, invest in their investor DNA. So diversification is spreading yourself thin, investing in things you don't know, because risk isn't in the investment, risk is in the investor. And if you invest in things you don't know or understand, you're taking unnecessary risk, and risk is the enemy to return. I know it's been sold differently, that high risk equals high return. You know what? When people tell you it takes money to make money, it doesn't take their money, it takes your money, right? Or when people say high risk equals high return, they take no risk, you take the risk while they get the return. So once you understand the rules of the money game, then you can say, look, it's a cash flow game, it's a make money on the buy game, it's a game of value creation, and you don't just hand your money over to so-called financial experts that are paid solely on commission or tell you to wait 30 years for it to all pan out. We would never wait 30 years to see if something was working in our business. And you guys are in technology, so here's something everyone should know. A lot of businesses in the S&P 500 are not going to make it. They're slow, dogmatic, dangerous, and just shitty companies we wouldn't want to ever deal with. But if you go diversify in that and you put it into these 500 companies that you don't know what's going on in their boardroom, you don't even like the technology that they're utilizing, you're robbing from your own business. And when they go out of business, they just replace that with a new company. So even though you have a 0% return on part of your portfolio, they don't run it as a zero in the future. They replace it with this new company and give you an average return that doesn't equate to your actual return. It'd be like you having a business, having a division that goes out of business, and then just saying, well, we're not going to count that. We're just going to pretend that shit didn't happen and tell everyone that our growth this year was 20%. But the reality was your growth was 12% if you account for that loss. So there's so much that I could talk about in this, and but I just want to let you know that. So investor DNA, invest in things that you understand, invest in things that you know about, and invest first and foremost into your business, and then use this process of cash flow banking that I teach to automatically capture wealth by saving interest and insurance costs and taxes, and use that to capitalize on the personal side.
And just on that, Garrett, the return on equity, I think most entrepreneurs never run the ROI of leaving $1 in their business. You said it earlier, a lot of people are living a lifestyle, so they're sucking their business drive, their cash flow, and it's stopping them from being able to reinvest. And if you take the money out of your SaaS business to go buy other, diversified portfolios, and you've never run that report to understand what $1 left in your business return-wise, for a lot of companies, it's at least 50%, right, Garrett? Like, you can't find investments that you understand, you control, you know what I mean? And like, just have a little bit more faith in yourself, have a little bit more discipline, get that team put together so you can sleep better at night, and it'll take things to the next level.
What's funny about tax? Nothing. but we might as well figure it out so you can keep a lot more of the money you make without tipping this partner called the government. Click here to find out more.